Right now, the entire global economy feels like it's balanced on a knife's edge. You've got record debt, markets that feel a little too euphoric, and these huge structural shifts happening all at once. We're going to break down the signals that suggest the system is way more vulnerable than most people think. We're always looking for that one big, dramatic event that screams crisis. But what if that's the wrong way to look at it? What if the crisis isn't a sudden crash, but more of a slow motion unraveling? What if all the signs are hiding in plain sight and we're just calling it the new normal? So, to really see these signs for what they are, we need a map, a blueprint. We need a way to understand how these massive economic shifts have played out time and time again all throughout history. And that blueprint comes from Ray Dalio. He calls it the big debt cycle. Think of it like the life cycle of an economy. It starts off great with healthy growth built on smart borrowing. But over time, that borrowing gets excessive. It creates asset bubbles, euphoria, everyone thinks the party will never end, but eventually, the debt just gets too big to pay back, and the whole system starts a painful decline. This isn't a new idea. This cycle has repeated for centuries. So where are we? Where is the US on this map? Well, after World War II, you had this incredible boom. Then the 80s hit the gas pedal with deregulation and a massive expansion of credit. 2008, of course, was the near-death experience, a classic bubble bursting. But here's the crazy part. Instead of actually dealing with the debt, we just papered over it and piled on even more. And that brings us to today, what Dalio's framework would call the terminal phase, the endgame, marked by, you guessed it, record debt and wild market euphoria. And if you want a number that really puts that debt into perspective, here it is, 122%. That's the projected U.S. debt to GDP ratio by 2034. It means the country's total debt will be over 20% larger than its entire economic output for a year. That is a massive, flashing red light telling us the burden is becoming unsustainable. Okay, so if we really are in the final stage of this massive cycle, then the cracks, well, they should be visible right now. So let's dig into some of the data points from 2025 that are pointing to this exact fragility. First up, the inflation problem. Just when it looked like we were getting it under control, a new tariff shock threatens to bring it roaring back, with average rates jumping from 2.5% to 15%. And the impact is pretty direct. For every 1% tariffs go up, consumer prices are estimated to rise by about 0.1%. This puts the Federal Reserve in an impossible position. Do they raise rates to fight this new inflation and probably cause a recession? Or they cut rates to keep the economy going and just let inflation run wild? And this dilemma is causing a real credibility crisis for the Fed. Ruchir Sharma captured it perfectly here. The market is basically begging for rate cuts, but the inflation data is screaming, don't you dare. This political pressure to just ignore what the tariffs are doing to prices puts the Fed in a no-win situation, and that just amps up the risk for everyone. The second crack? It's showing up in the very foundation of the financial system, the U.S. Treasury market. I mean, this is supposed to be the safest, most stable market on planet Earth, but things have gotten so strained that the Treasury has to step in and buy back its own debt just to keep things running smoothly. In one recent case, investors were desperate to sell, offering almost $20 billion in bonds. The key thing here isn't the specific numbers, it's the fact that this intervention was necessary at all. It's a huge sign that the system needs life support just to function. And while the government is struggling, the private sector is running on pure speculation. Margin debt, that's money people borrow to buy stocks, has blown past $1 trillion for the first time ever. Now, this is absolute rocket fuel for the market on the way up. But when things turn, and they always do, all this borrowed money will force a tsunami of selling, turning what could be a normal correction into an absolute crash. And all this speculation has a poster child. The clearest, most obvious symptom of this late cycle mania is the AI boom. It is a classic bubble, hiding in plain sight. I mean, the parallels to the dot-com bubble are just impossible to ignore. Back in 2000, the big story was the new economy, built on telecom infrastructure where eyeballs were more important than actual earnings. Sound familiar? Today, it's artificial general intelligence, built on AI infrastructure, where gigantic valuations have absolutely nothing to do with revenue. The story is exactly the same, only the tech has changed. Just look at these numbers. They're wild. OpenAI gets valued at $300 billion, while losing $5 billion on just $3.5 billion in revenue. Anthropic lost over $5 billion on revenue of just over $1 billion. These aren't businesses in the traditional sense. They are cash incinerating machines funded by pure speculation on a future that, frankly, might never show up. So the core flaw here is something called negative unit economics. To put it simply, for a lot of these companies, it costs them more money to provide their service to one customer than that customer actually pays them. They literally lose money on every single transaction. That is not a sustainable business model. It's the very definition of a bubble built on a foundation that's economically broken. Now, this crazy combination of extreme debt and a speculative bubble isn't just some domestic US problem. Oh, no. It is distorting the entire global economy, and it's pointing to a massive rebalancing on the horizon. This chart, this chart right here, might be the single most important picture for understanding where we are right now. The US stock market makes up almost 70% of the world's total stock market value. 70%! Yet the US economy only produces about 27% of global GDP. There has never, ever been a gap this wide between financial hype and real economic output. Ruchir Sharma does not mince words on this. He calls this historic imbalance the mother of all bubbles. The big consensus on Wall Street is there is no alternative to US stocks. But history shows us that when everybody believes the same thing, that's usually the most dangerous sign that you're standing right at the peak. So, what does it all mean when you put all these pieces together? Well, the evidence points to a timeless lesson. The forces of debt, human psychology, and political power, they all combine to create these massive long-term cycles. And no matter how badly we want to believe that this time is different, the cycles always eventually turn. Look, the data and the historical framework, they all suggest we're in the final phase of a credit expansion that's been going on for decades. The unwinding probably won't look like 2008, but it's likely to be a much broader, more structural reset. The question isn't if it will happen, but how it's all going to unfold. Cycles don't lie. The real question is, are you prepared?